Hello and welcome. Thank you for joining us today for this webcast, Lending and Restructuring in the COVID-19 Environment. My name is Jeb Schmidt. I'm Managing Director with Gleason and Associates, and I'm a member of the board of the Pittsburgh chapter of the TMA. I would first like to thank ourselves, but thank our sponsors, of course, including Gleason, and all of our wonderful sponsors. We'd not be here without their generosity, especially in this time when things are uncertain. So we're very grateful for their support. Their logos are being shown on the screen at this time. If you're interested in becoming a sponsor, please let me know or reach out to Micah Whitfield, Director of Business Development for TMA Pittsburgh. We have lots of more exciting virtual content coming your way, so stay tuned. We're love to have you here today. So we appreciate your attendance and we appreciate the support of our sponsors. Moving on to today's event, I'd like to introduce our moderator and our panelists. Moderator is a friend of mine and a coworker for a long time, Bill Krieger. He is Vice President and Managing Director and a shareholder at Gleason and Associates. Bill has over 35 years experience in the areas of accounting, finance, financial analysis, business development, revenue cycle management, mergers and acquisitions, and turnaround management. Bill will be moderating a distinguished panel, including Kirk Berkeley, Anthony Carpentieri, and Michael von Lehman. Kirk is the current president of the American Board of Certification and the managing partner at Bernstein Berkeley, PC, with locations in Pittsburgh, Cleveland, and Wheeling, West Virginia. Kirk is experienced in representing secured and unsecured creditors in bankruptcy, financial restructuring, and workout situations, including the representation of numerous unsecured creditors committees, equipment lessors, and commercial landlords. Kirk has been named to the Pennsylvania Super Lawyers list every year since 2013 and has been recognized by Best Lawyers every year since 2011. In 2020, he was named to the top 50 Pittsburgh Super Lawyers list and was the only attorney specializing in bankruptcy and restructuring to be included on this list. Anthony is a vice president at JP Morgan Chase. We welcome him to this presentation. Anthony started in ABL in 2012, working as a credit analyst at JP Morgan. Anthony worked in credit for 3 years before moving over to the origination team and is currently covering companies ranging from 20 to 500 million in revenue located in Pittsburgh and in the New York City markets. Michael is a director with Schneider Downs Meridian, as many of you know, joining Schneider Downs in 2015 with its acquisition of the Meridian Group. During his career, he has worked with scores of companies from many industries, providing each client with in-depth analysis and consultation in order to become more efficient, more profitable. Key industries where Michael's guidance has led to a financial rejuvenation are manufacturing, distribution, construction, and real estate. So that is our panel. I'm sure this will be a great presentation and very insightful to today's environment. So with that, I'm going to turn it over to Bill.
Thanks, Jeb. Hello, everyone. Good afternoon. Welcome. I'm sure we've all had different experiences using Zoom over the past few months, whether it be for business or with our family. This is the first chance I've had in doing a presentation, so I'm very much looking forward to it. And I think with the group that we've put together, it's going to be very interesting for you. So today I get the easy job. I get to answer the questions, and somebody else for a change gets to come up with the answer. But in this virtual setting, it doesn't just have to be me putting up the questions. I've had a chance to take a look at the attendee list for today, and there are some very bright and I'm sure inquisitive individuals out there. And so I'm looking forward to getting some questions while we're in the process of this discussion. I have a window open, so as your questions come in, I have the opportunity to see them. If you don't direct it to a particular individual on the panel, I will do it. And so with everyone participating in this session, I think we'll find it goes very quickly and we'll all get some interesting insights into it. So with that, let's get started. So the purpose of this presentation is to examine both lending and restructuring in the current COVID-19 environment. And certainly there's no restructuring without lending. So it seems like lending might be a good place to lead off. So I'm going to start with Anthony since he's on that side of the business and get some idea. So Anthony, tell us, what's the current state of the union? How's credit availability? What type of deals are you seeing getting done? Give us some insight into what's happening at the bank currently, and even how it's evolved over the course of the last 7 months or so.
Sure. Yeah. Thanks, Bill, and thanks everyone for having me on this panel. So it's an interesting question. It certainly has changed a lot over the last 6 months. And to answer that question, maybe just take a step back. I think when this first happened with COVID, for the first couple of months, it was pencils down on any type of new deal lending, right? What we were focusing on at that point was what was our own portfolio, dealing with draws, upsizes, companies taking protective advances, right? So that was really the focus. That has shifted, I would say, maybe 2 months fast forward ahead of that. It was more generational type opportunities. And by that, I mean, deals we've been trying to get, but have been unable to. And now we have this chance because something may have gone wrong, with a PPP loan or what have you. And that was really the focus. And then fast forward another 2 months to kind of where we are today. And I would say the general environment is much more normalized. We are open. We are getting term sheets out. We've certainly seen a lot of activity, particularly in the asset-based market, which is where I sit in and originate. So I would say our activity is not back to where it was because we are looking at things differently. I think the market, from a pricing perspective, is still not necessarily back to where it was pre-COVID, but much closer than where we were 2 or 3 months ago. But in terms of the lending market, we have certainly refined how we look at things. And I would really break that down sort of in 3 categories. The first one would be industry, right? We are very focused on what industry you're in. Obviously, certain industries, retail, for example, not e-tailers, but retailers, have been significantly impacted. Other industries, whether it be oil or gas, we want to be more cognizant about where you sit in your industry. That would be number one. Number two would be we're doing a much deeper dive on recent performance, projections, right? I think historicals today matter much less with what's going on. So we're doing more trends analysis, month-to-month type stuff, looking at projections, seeing where the company expects to be. I think you really have to do a deep dive on the analysis. And the last thing I would say is a key component of this, and they sort of segue into each other, is PPP/availability, right? So when I say that, I think there was an influx of cash that came on for these companies with PPP loans, and that certainly helped get them through a couple of months. But now you're looking at it, they probably should have spent all of that or a decent portion. What does their availability look like with the PPP? And then did they have enough to get themselves through the next 6 months or a year if there is another second downturn or whatever we describe it? So I would say, to reiterate, market is open. We are active. We are getting out term sheets, but we are just looking at things a little bit differently than we were pre-COVID.
Are there any industries or areas that you would consider untouchable at this point, given the situation and the uncertainty that there is in the market?
I wouldn't say anything is untouchable. No. Right. So it's sort of 2 things. We have internal companies that we are moving from cash flow to the asset base just because it's a more secure structure. We are seeing a lot of retailers, right, just because it fits the asset-based world better. So in terms of new business, if we're talking, I wouldn't say anything is untouchable, but we are obviously more concerned with specific industries, right? So again, if you're in the retail space, but you have a significant e-commerce presence, well, that's going to make us feel a lot better about your business and trajectory. So there's nothing that's really a hard stop, but certain industries we consider high risk. And those are ones we need to have a lot more information about and make sure we're comfortable with.
And you mentioned e-tailing. Are there some of the industries at the other end of the spectrum in terms of industries that you're actively seeking opportunities?
Yeah, so great question. We have seen a lot in the beverage space just because I guess everyone's drinking right now with what's going on. So that's been a good spot for us for sure. We've been seeking that out. I would say that's kind of the key one that I've seen more opportunities in right now, where we see a lot of growth and some good performance. Food distribution has done very well in this segment, right? So you got to make sure you're doing a little bit less food service right now. So that's a case where retail has been good, right? Food service, supermarkets are doing very well, Costco, all of it. So that's why I don't want to say specific industry, just retail. The athletic leisure space, for example, has done very well, where people are wearing shirts like we're all wearing on a Zoom, where it's not maybe as formal as it used to be. So you really have to dive in. We have seen good growth in certain industries for sure, and then others that have been impacted a little bit more negatively.
Good. So Kurt, I know you have a number of corporate clients out there, and that you're working not just on the restructuring side, but helping them in terms of just general business operations. What are they telling you? And in terms of who's telling you what, can you give us a sense of what business they're in and how they're doing right now?
Sure. The first thing that I want to talk about is, I kind of want to go back to that March timeframe when we all started to first learn about things shutting down. I remember, I think the first news that I got where I realized something was changing was when they canceled the St. Patrick's Day parade, and started to get some calls from people. And then, as everyone will remember, it was day to day. What was being canceled, what was being shut down, and then the governor's essential and non-essential list came out. And I turned pretty quickly from lawyer to therapist for a couple of days, where I fielded a number of calls. I remember it like it was yesterday. It was all day long for a few days on clients just wondering what to do, and what to do with the fact that whether they were on the essential list or not on the essential list. How do you get on the essential list? Many questions I didn't exactly know how to answer. I'm not sure many people did. But in those beginning stages, I think that everybody I talked to was panicking on some level. Many of them were handling it better than others and had plans and asking questions such as, some of the bankers might not want to hear this, but asking questions like, should I just immediately draw down on my entire line of credit?
Sure.
And all the bankers, I'm sure, were looking at their loan documents to figure out what their customers could do. But initially it was a sense of, what do I do? Especially when even just questions like, I remember I had a client in the contracting space that his particular business was deemed non-essential, but he does a lot of work in the oil and gas space, and oil and gas was essential. So he was getting calls under his MSAs from some of his customers saying, get out here and do work. And he was saying, I can't, I'm not allowed. And so navigating those issues were very difficult. I remember even just questions from a limestone miner that I knew that was non-essential, but power plants were essential. And so the power plants were starting to call the governor saying, those air scrubbers that we use require limestone. So, it was all working through those issues at first. And I also became somewhat of not really an expert, but had to help people through just things like, what do you do for those companies that were allowed to work on COVID related stuff? And a lot of it was common sense, but also just trying to figure out the guidelines day to day on what you do when you have employees that are allowed to come back to work. And so, just dealing with a lot of those issues. Since then, what I would say is it's, a lawyerly answer of it depends, but it depends on who they are, what business they're in. For example, I have a client that's in the home furnishings business, and they are just absolutely crushing it. They're having the best year that they've ever had. And, when I talk to them about why do you think that is, it's, well, everybody was sitting in their house for 3 months, staring at whatever it is, whether it was your carpet, your windows, and saying, I need to replace those, and I've never done it before, or I've been wanting to, and now I don't want to stare at them anymore. So let's change the carpet or fix the windows or whatever it might be. So industries like that, they're expanding. There are some industries, clients in the metal space that are still doing very well and expanding, because maybe the tariffs have still helped them, in the manufacturing space they're selling into is still doing fine. So they're growing. You certainly see the industries that are hurting. It's retail, for example. But I would say even retail, I've seen some differences. It depends on where you are, what type of retailer. If you're out in a mall in a tertiary market, or a big box out parcel somewhere, like, you're struggling. If you're in the right market, a key market, if you're up on Walnut Street and Shady Side, you're not doing so bad right now. So, it still even depends on where you're located, what kind of goods you're selling. And in particular, and there's been a lot of panels just on this topic, but on the retailers versus e-tailers, those retailers that successfully moved more into the e-commerce business and just have more of marketing flagships in key locations did just fine. They paid their rent for the most part, even through the pandemic. So it really depended on the type of business. There are some restaurants, believe it or not, that I've talked to, clients that, while they're certainly dealing with tough times, are looking for expansion because they're trying to figure out which one of their competitors are all going under and what market share they can capture if they can be the one that survives through all of this. So it really comes back to the things I'm hearing and I'm seeing are the companies that were generally responsible, expanded in a responsible way, and were prepared, not necessarily for a pandemic, but were thinking about their business in a smart manner, had dealt with the changes that we saw in the economy just generally in the past number of years. They're doing okay. Of course, you have some different industries such as transportation. I don't represent any airlines, but I represent and talk to some other transportation type businesses that they might be seeing a different world out there. Bus companies, so some of them are hunkering down, pulling back, conserving cash, and trying to see if another lifeline comes out of the government.
In terms of what about M&A activity? You've talked about a little bit about those companies that were best prepared for maybe not a pandemic, but best prepared for, let's say, opportunities or downturns. Are you seeing any M&A activity amongst your clients, or at least an interest in it at this point?
I'm seeing an interest. There's a little bit of activity, but I would call it more of an interest. I would call it people getting some of their dry powder ready and looking for the deals that are going to be coming out probably in the early part of next year. So I personally have not seen a lot of M&A activity right now, but definitely have been hearing from clients and others about getting ready to do it. And there are a couple small deals going on right now. People are, and not all of them were just in the works pre-COVID. Some deals getting done right now, brand new deals. People are still obviously looking for deals, and even more so than they were before. But I would call it, what I'm hearing and seeing right now, it's more about getting ready for next year.
Well, speaking of next year, I don't know if you guys have heard at all, but we have an election coming up here in short order. I'd like to get each of your perspectives. We don't know what the outcome is going to be, but I think there's certainly some polls that are out there. And because Michael's one of my competitors, I think I should pick on him first and say, get out your crystal ball, Michael. Tell us, what are you seeing? Do you have any thoughts in terms of how the environment is going to change from this point forward, especially in the context of the upcoming election?
Well, it's funny, we did our rehearsal 10 days ago, and it feels like that was a lifetime ago when it comes to politics right now. So guessing what's going to happen, a month from now might be a fruitless endeavor. From our perspective, when you're dealing with kind of the struggling companies that certainly represent a large portion of who I deal with, it's not a big deal to them. There's obviously, the coal guys and the industry that goes around that, the mask makers and all of that stuff that are interested. But quite frankly, if Trump wins or Biden wins, the coal industry is going to stay on the same trajectory it's been on since 1955 or whatever it has been. I think where you actually see it coming to play is you have this culmination between low valuations, and if you're really looking to do estate planning or succession planning, now's the time to do it. You have low valuations, you know what the capital gains taxes you're going to take are right now, and you don't know if that's going to be true next year. The more we get, the stock market right now is seems to be reacting as if they're assuming it's going to be a Biden win. But from the day to day, a day to day, I'll call it a smaller or mid market company. Politics takes up way more of the conversation than it does impact on what they should be doing at any given time. That's certainly what I've seen. You get into the stimulus. They came out and said, the last 5 days, they've gone back and forth on whether they're going to pass stimulus. I know there's a lot of people that really would like more stimulus. I think I'm starting to see for the first time in this downturn, I think over the last month, you're starting to see, higher end jobs go away. It started out, it was waitresses and waiters and laborers. And now I think you're starting to see that creep in. And they're, I think, going to want to pass some type of stimulus in hopes of keeping the economy rolling from a discretionary spending and that end. But other than that, I'm not seeing a huge impact. I don't know if Kirk or Anthony, you're seeing anything different right now.
No, I would echo those thoughts from my perspective. Look, I'm mostly in the middle market space, right? I think every company is more focused about how to survive with COVID and maybe less so focused on the upcoming election. So my general thoughts would sort of echo exactly what you just said, Michael, that I don't think it's going to be that much of an impact, or at least as of right now. Just maybe creates a little bit more uncertainty, but I don't see a huge impact day to day on these companies in the space that I sit in.
Kirk, any thoughts?
My thoughts, I do want to echo one of the things that Michael said that I think was very important, is that people were spending way more time talking about it than the comparable impact. But at least from my perspective, on what I'm hearing from a lot of clients, and really not a position on they want one particular person to win or another, but they want it over because they want to know
they're not alone.
It's that certainty aspect of, they want to know and plan for the future, and they want to deal with COVID. And right now, this uncertainty and this distraction is just that, such a huge distraction. And so there's a lot of maybe angst is the right word, on just where are we going to be? Where are we going to go? What kind of stimulus is there going to be? Is there going to be one at all? What's it going to look like? And in particular, I'm going to give you just a couple of very specific examples where there's some concern, or at least wanting some certainty. One is that we're primarily talking here about commercial aspects, commercial insolvency, COVID. But let's not forget that the thousands and thousands, if not millions, of people that have lost their jobs and have been surviving on stimulus checks. Mm-hmm. And I don't say that just from of course the moral perspective, we should think about it, not forget, but what that is going to do to business when next year millions of people can't pay their mortgage, can't make their car payment, file individual personal bankruptcy, is going to have a significant impact on all of these companies that we traditionally represent and deal with here in the world that we're dealing with and talking about today. So that part is coming.
Yeah.
And when those checks run out, it will definitely come. And the second piece of it is, when you deal with landlords, in particular landlords that have residential tenants, that they are not allowed to evict right now, and that don't have to pay their rent. What happens here eventually with a stimulus, with the election, CDC guidelines, has a very significant impact on what they are doing and able to do right now.
Yeah, that's what I was going to mention before you even said it, is the issue in terms of the lack of pressure on those individuals right now. Certainly they have the pressure of having lost their jobs, but they're not having, the situation where they have their landlord, beginning eviction procedures. And certainly that's going to happen at some point in time. And depending on what a stimulus looks like, may serve to either accelerate that or defer it for some period of time. Something that Michael had mentioned too, Jeb and I spend a lot of time in the business valuation space as well. And we are seeing some of our clients trying to do some year-end planning because they have concerns as to how taxes are going to change going forward, from an estate planning standpoint. And so they're eager to try to make some plans before the end of the year and try to get those issues resolved. Things that have been on the back burner for some time, but really coming to a head now as they are looking to, what the future looks like in terms of particularly in inheritance tax issues. So turning to the restructuring side of things, Michael, I know you're frequently working with banks and their troubled credits. How's business? What are you up to these days?
It's a little slow in the sense that if you go back to Kirk kind of talking about March, it was, those first 3 or 4 weeks, it was the sky is falling. No one's 100% sure what to do. And you're having conversations that you have when you don't know what to tell somebody or exactly what the future holds. You're saying, conserve all your cash. If it's not payroll or trust funds or my bill, it doesn't need to get paid, and conserve everything you can so you can see kind of where the chips fall. I think since then, and Kirk, you might be running into it differently. Banks have really stood down. I mean, unless you were really in trouble before this, they haven't taken action against anyone. I think they're swamped. They're trying to go through this. If they threw out every company that had a bad second quarter, they would have no clients left. Even companies that have come back were down, 40% in revenue in the second quarter just because they weren't allowed to be open. They couldn't deliver product. They sent their employees home for 3 weeks, whatever it may be. So banks have been really patient. I think they're going to continue to be patient until the end of the year. Then you start running into the problems of you're going to have a lot of covenant defaults because your 12-month rolling average is going to be, 3 quarters of COVID in it. They continue to be really patient. The place where we actually saw the most activity was quirky businesses that were small enough, middle market businesses, but somehow didn't qualify for PPP. They had too many part-time employees, or they had some other issue that didn't allow them to qualify for PPP. And it just they slipped through the cracks. And that was, that's where we spent most of our time, or on engagements we were on before. But even struggling companies, in a lot of ways, PPP threw them a lifeline. We had clients that were significantly smaller now, but they got PPP based on their 2019 payroll. And it really gave them, 4 times payroll instead of 8 weeks, it got 16 weeks. And they're going to have to pay some of that back. But they're sitting there saying, hey, I'll pay it back in 2 years kind of thing. They're starving for cash. So any cash is a way to move forward. So PPP really worked very well. I think it might ultimately end up being an 8-week or 12-week solution to a 24-month problem. So that's why they're talking about more stimulus. But for right now, I see a lot of banks just taking a very patient approach because one, they don't have a lot of options, but 2, I think they really do understand the position that everybody's in. And for what it's worth, they can empathize. And then the OCC, I don't think, is breathing down their necks, because the OCC recognizes that this is a systemic problem that isn't related to their handling of their loan portfolio. So I think everybody stood down, from landlords to vendors that were owed money, to banks, to the OCC, and kind of is trying to help people get through it, or help entities get through it, unless it was an antagonistic relationship before this started, in which point you're probably just boiling over. And now you may be surviving because somebody like me is telling you, or telling the bank, I don't know what your alternatives are right now, other than to wait and hope it gets a little bit better. If your position's not going to get worse over the 6 months, let's just figure it. Let's give them 6 months and see what happens.
So even accounts that were problems pre-COVID either got a lifeline through the PPP process or are benefiting from the banks standing down at this point.
Yeah, I mean, I've seen I can probably count on one hand the amount of engagements I've been in the last 6 months that started like most engagements where receiverships being threatened or it looks like you're going to get pushed into bankruptcy, confessions of judgments are being filed. It's starting to come back a little bit, creep back a little bit, particularly with non-traditional lenders, somebody that bought the debt at 30 cents on the dollar or something like that, and probably bought a pool of debt and just watched half of it go poof and now needs to figure out how to monetize the other half of it. You're seeing it a little bit more with those, but for the first 60 to 90 days, I mean, the only thing the bank cared about was making sure that their creditor got PPP funds and doing whatever they could to get those PPP funds. And quite frankly, I think every bank had everybody that wasn't an IT person filling out PPP forms for 6 to 8 weeks. So, and with those funds, you bought yourself another 8 weeks. So it's really gotten to a point where unless there was something going wrong, terribly wrong, where there just was a bad relationship to begin with, everything and everybody's kind of pushed pause, at least up until this date. Now, like I said, we're starting to get those calls that, hey, we're looking at filing, we're getting confessions of judgments. But even those, you're still, well, let's get on the horn and see if we can buy ourselves 90 to 120 days to find an alternative solution rather than running into court and starting to spend a lot of money when I don't think it's really necessary right now.
Yeah, we're getting some comments from the audience in agreement that the banks have really been patient at this point. But Anthony, I know you don't work in the restructuring side of things or the troubled asset side of things at the bank, but I'm sure you have plenty of conversations with others there. Do you anticipate that the banks are going to get serious about this in 2021? And even if we have a situation where a credit didn't have a problem pre-COVID, that the banks, assuming that they've got the wherewithal to actually do it based off of regulation, do you expect the banks to hold off or start to take actions?
Yeah, so I would just say, look, we do see companies that are not performing well a lot just because in the asset-based world, it's a riskier structure for the bank, right? And I completely agree with Michael. I think we expected more of a rush of what we call self-help deals where we move them into an asset-based structure than we certainly experienced. And I think it's everything you mentioned is spot on in terms of why, right? It's the PPP loans, which really helped. And then maybe just the one thing I'll add is you always have to do right by the client. And what I've experienced is when you look at what happened, it's generally industry driven, not client driven. And so what you had was a really good company for a lot of years that all of a sudden got hit very hard. And our reaction is to work with them, figure out a solution, never to kick them out, right? And to figure out what's the best steps forward. So I think that's the bulk of what we've seen was a company that had steady EBITDA, good performance that just got hit with everything that's going on, right? And so we are going to do what's right by them, what's right by the bank, and make sure that we have some sort of a cohesive structure going forward, whether that means asset-based. That's how we've been looking at it, figuring out ways to potentially get them more liquidity to help out where we can. But no, I agree. I mean, we have not seen a ton of these type transactions because I think everyone was just trying to figure out what's going on, what's the impact. And the other thing too is a lot of our borrowers, maybe reporting quarterly, so you don't have as much visibility. And as we start to see more months of COVID, and that trailing 12 month now is like you said, 9 or a year, performance may slip, and we'll continue to monitor that and do a good job of it, right? But I like I said, I do agree with Michael's comments.
Yeah. Just a reminder to the audience, if you've got questions, I get them here live and I can pose them to any one or all of the panelists. So feel free to interact while we're doing this presentation, or you can certainly save them at the end. So Kirk, you referenced this earlier when we were talking about the lending side of things, in terms of, COVID is disproportionately affecting different individuals, businesses differently. And so, we've got changes in consumer behavior. We've got a wide-ranging lockdowns that are taking place. In terms of industries, maybe you can give us a few anecdotes of what you're seeing in some industries. One that I'm interested in hearing about is certainly on the commercial real estate side, and and I know you've got some clients in that area. What are you seeing from that standpoint?
From the commercial real estate side, let me just kind of start with a little story about something I'm dealing with right now. It's a smaller property, client purchasing it, retail, leases signed before closing for 100% of the space in the building. And going around to some of the usual suspects of their real estate lenders and saying, hey, I got a new deal. It's not a large deal. And some of the real estate lenders saying, retail, not doing it. Love you. You're a great customer, fully leased. We just can't do it. Our bank, and that's come out of many banks. We're just simply not doing retail right now. So, it certainly has impacted negatively the commercial lending space in the retail world. I think it's obviously caused a lot of bankers to sharpen their pencils just in anywhere in commercial real estate right now. But contrast that with if you have office space right now, particularly tech office space, you're doing just fine. There's still a lot of construction going on in the city. There's still a lot of leases and deals being signed. You can look down at the McCafferty property and some big deals that have been signed and going on down there. So it really depends on, again, the type of space and the location, the type of tenants and the tenant mix. You also see, even in the retail world, let's call it in the restaurant space, do you have a shopping center or a good mix of tenants where, I had a client who put it to me like this once, that the restaurant, maybe it's the Chinese restaurant in your local favorite shopping center, that's the owner's job, right? They have to get up the next day and work and keep that restaurant going. And so if you've got a space with a lot of smaller tenants like that, they're finding a way to work through this. The other thing that's interesting there that I'm also hearing from both on the tenants and the landlord space is you've got a lot of, the other thing I want to mention too is if you have alcohol sales, particularly if you have like a brewery or you're brewing your own alcohol or your own liquor, they're also doing well. But here's the other interesting thing that I'm curious to see how this plays out, is that you've got a lot of restaurants that were never on Grubhub or DoorDash. And if they transferred their business and got onto, let's say, Grubhub during the pandemic, and now they're getting, I don't know, maybe it's 25% of their business through those online portals. When they start to open up, for 100% capacity, that is expected to be another 10% of revenue that they never had. Once you kind of get fixed on one of those, online services and gather that. So you will see, and you are seeing from the landlord tenant relationship, just like, the discussion about the banks and their clients, you're seeing a lot of the landlords say, okay, was my tenant doing fine, or was their trajectory up or down pre-COVID? Right. And if it was up, if they were doing fine, I'm going to give them some breathing room for a little bit. And then kind of on the converse though, but I'm going to make this end here. And I want them to start paying me because I do believe they have a good business. And I do believe that the business can make it. And it's a tenant that I want and should start to pay me pretty soon. Hospitality, as I'm sure everybody knows, is in trouble. I mean, the hotels are really struggling. I'm working on several deals right now, lender side for, in the hospitality industry, and hospitality is really struggling. And I can't think of many locations where hotels are doing great. I'm sure there's a few diamonds in the rough, but that's a real troubled industry. And I certainly have seen as well a definite distinction in pre-COVID versus post-COVID. So again, it's kind of that discussion on, was this asset struggling pre-COVID? If it was, we're going to look at it differently. That doesn't mean I agree with the comments from the other panelists that I don't see many banks doing a whole lot right now to, take action, but I definitely see a difference in how they're viewing it for taking action in the future. If it was a non-performing asset, particularly in hospitality, I mean, there was some soft spots in hospitality before COVID.
Sure.
And a lot of questions about whether hotels were overbuilt and we built too many rooms. So I do think that that's a space that will get some pretty serious action and play next year as lenders start to work through. It also depends on the kind of lender.
Not only from a national standpoint, but a local standpoint, and looking at our area, any perspective on, given that our focus is more in the areas of education and healthcare and high tech and some service industries, which would include hospitality, do you see our local area faring better or worse than the national scene as a whole?
I see it faring better, and I'm not going to proclaim to be any kind of soothsayer on this. I'm just going to completely steal this from a conversation I had after playing golf one day about a month ago with some real estate investors who were in from New York, and their two primary markets they're investing in are Pittsburgh and Nashville. And I asked them, I said, why? Are you still doing deals here? And they said, absolutely. And I said, why? And the answer was just, they said, we look at it that Pittsburgh has one of the most diverse economies in the country right now, because all the things you just mentioned. We do have oil and gas. We do have education. We do have financial services. We do have healthcare. We do still have, advanced manufacturing. So even though some of those might be a little bit depressed or, not doing their best right now, we have a very diverse economy. And so at least what I've heard is that there's a lot of people that are still betting on Pittsburgh and will be investing money here.
I would agree with that. If you look at Pittsburgh, its economy it is so little is built on discretionary spending. We don't have tourism. We don't have auto manufacturing. We don't have a lot of discretionary spending built. We have schools, we have healthcare. So we've always been, immune from the lows, but also a little bit immune from the highs too. I mean, in the last, since the steel industry went down, we've been pretty steady Eddie for 25 years or 35 years now. And I think people see that. And when it comes times like now that are uncertain, the steady Eddie is a really good place to be still.
Yeah. Anthony, I know you work in a couple different areas, including New York and in our area. Are you seeing major differences between the two?
Not really. Look, I mean, most of the retailers we deal with are in the New York area. So I think, regionally, you just have more industries or certain companies in it. But I would say this is what we've been experiencing has been similar state by state. I basically cover any deal within the Northeast from Maine to Virginia that falls in the size range of like 15 million from a revolver. So I do see a wide range of regions. And I would say there's no trends per state that I've seen.
Yeah. So in terms of restructuring, I'm going to kind of turn back to that and Michael, in particular. So there's certainly going to be restructuring work that comes out of this situation, and probably more than we've seen in some time. But the question is, what structure does that restructuring, take? So given the types of industries that we're talking about here locally and nationally, some of which may not recover for some time, I mean, do we see more foreclosure liquidation situations than true, restructuring and reorganization situations?
Well, it's funny you ask that because you never know walking in what shape it's going to take. Generally speaking, in my career, unless I'm brought in, at the 12th hour and everybody's walking out the door and that's why you're liquidating it type thing, you can avoid a liquidation. There's always somebody willing to buy, generally buy a company. But a lot of that's dictated by the outside circumstances. I worked with a client not too long ago and, a rather large client, and we walked into a meeting with the bank, and this was pre-COVID, not by much though, but we walked into a meeting with the bank and the bank said, "Hey, we're kind of done. We're sweeping your cash and, we'll leave what's in your payroll account and wind up your affairs and it's kind of over." And all of a sudden you went from, "Hey, I think we can figure out a way to fund this, to turn this around in 6 months," to getting out the Pittsburgh Business Times and looking up everyone in their industry that's bigger than them and making phone calls and begging the bank for 3 weeks to get a sale done. And we got a sale done. But if you would have walked in there, I would have never guessed we were going to end up selling that company in 3 weeks. So I think you're probably going to see consolidation. You always see that during big downturns. You're going to see exactly what Kirk kind of was talking about at the beginning when he was talking about the M&A. Right now, I won't call them the titans of your industry, but if you're dealing with a competitor that's more efficient and better well run, I can almost guarantee that competitor is storing money away right now and waiting for you to slip up thinking that they're going to be able to buy you for 20, 30, 40 cents on the dollar. I think you're going to see a lot of that. You certainly will see liquidations, but I think you're going to see liquidations mainly in industries that were probably changing before this. Retail was probably changing before this, but and there's just no reason to sell a retail business for all intents and purposes. And you're going to see a lot of restaurants and things you're going to see 50% of restaurants. I don't think are going to survive this, at least not in areas like downtown. You walk downtown right now and there's 20 people. I couldn't believe it. I saw somebody in a suit the other day. It was probably the first time I've seen somebody in a suit in 6 months.
I had a deposition. What do you mean? I have to dress up.
But yeah, it's you're certainly going to see liquidations on that front. You're going to have a liquidation here or there, but I'd almost think that the things that were going to be liquidated have probably quietly shut down over the last 6 months. Generally, when we walk into something, if it can't survive, the first thing you're doing is trying to find somebody to buy it. And I think you're going to see a lot of that. I think you're going to see a lot of people are on the sidelines right now in the M&A market. Multiples aren't coming down. If anything, they're going up. People are saving money. And right now there is a lot of people with money that are looking to make smart investments, and there just isn't a lot of inventory. So I think once that inventory you're going to start to quickly see transactions getting done.
So Kirk, what about Chapter 11s? And in particular, a subject that I'm interested in terms of the subchapter 5 small business Chapter 11 reorganizations. What are your thoughts on that? Are you having any consultations with clients now about that as a potential avenue?
Absolutely. And for those that don't know, subchapter 5 of Chapter 11 was the new, I guess we'll call it the subchapter of the bankruptcy code that was implemented in February of this year. It's almost as if someone knew. And the subchapter 5 it really is. When it first came out, I remember being at a conference and in DC, I think it was the NCBJ last year in November when the bill was first being debated to be passed. And everybody was calling it the Restaurant and Hotel Bankruptcy Act. Joking around about it doesn't seem so funny anymore. And it really was meant for those sorts of small businesses. And the single most important thing about subchapter 5, which will be important, is that it allows the owners to keep their equity with virtually no trouble from the lender. And so if you're a small business, it's also a significantly streamlined, faster, hopefully that means cheaper process. So if you're a small business, you were contemplating bankruptcy previously, the small business provisions of Chapter 11 really didn't get you a whole lot. It wasn't a whole lot faster. It wasn't a whole lot cheaper. It didn't give you much more protection. So this truly is a real, I think from just an objective standpoint, a good workable small business bankruptcy provision. And yeah, I've had conversations. I'm having conversations with a client right now who is in one of those situations where, they've got some trouble with their lender, and the lender is doing what we've all talked about, not really taking a whole lot of action right now, but it might be coming if we can't get to a deal. We're trying to work on an out of court deal. But if not in the end, I think that subchapter 5 is a pretty easy way to deal with the situation. On the flip side, I represent a lender in a subchapter 5 case in Ohio. And interestingly, the business is a company that licenses, produces, and sells to houses of worship their music. And so just, one of those other interesting things I know in this industry we love is, you don't think about that, but well, houses of worship haven't been there. So they haven't been buying music. And so the business is severely depressed. And this was a situation where the borrower didn't even, and whether this was a good decision on their part, I don't know, and their counsel didn't even tell the bank it was coming. One day called the bank, said, come into our offices, we want to talk to you. The bank walked in and they said, by the way, we're filing bankruptcy on Wednesday. And, I think though, it's part of what we just talked about a little bit is because it's streamlined, relatively certain on the result, I think you're going to see some more businesses do that. Just say with their counsel, let's just do it. Let's just go for it.
Yeah.
It gets me to the end. I know where the end is. I generally know how much it's going to cost. And I don't have a ton of risk, except the wild card that I see that most businesses that fit into subchapter 5, even though they increase the debt limit to $7.5 million, which probably covers a lot of cases in a place like Pittsburgh. But most of those loans, you're going to have a lot of SBA loans. And most of those loans are going to have, if they're SBA, they certainly will, but they're going to have personal guarantors. So that's the wild card that most of those guarantors are going to have to get counsel and figure out what that means to them when they put their company into the bankruptcy. But I think you're going to start to see a lot of them. And the other question for me is, do the banks then say, let's work it out in advance? Or do we go back to the days where the banks say, or the banker, maybe not the institution, says, I'd rather have some court say you owe me $2 million rather than $6 million. And so just go into bankruptcy and, we'll let it play out there rather than me have to make a decision and answer up the chain. Yeah. So, I'm interested to see how that plays out. Does it mean more bankruptcies because of that? Or does that cause discussions to avoid it because everyone knows the potential result?
Yeah. Well, as one of the 4 trustees here in the Western District handling the subchapter 5 cases, just a quick update on what's happening in this district. Through last week, there were 7 cases that have been filed to this point. One, interestingly enough, a restaurant case was almost dismissed immediately after that, and I think they've pursued a more traditional shutdown liquidation type of setting. But I'm on 2 cases currently, and I think both have a very good chance of being able to reorganize in a situation where owners can retain some level of equity. Fortunately for them, they've got some assets to work with to be able to manage through it. But it's a great timeline in terms of how quickly it moves. And I know for some of the attorneys out there in the audience, maybe some of whom have participated in this, there's some templates being put together, like a template reorganization plan. You don't have to do a disclosure statement in subchapter 5, but you have to have a plan. And so how can we structure a template plan to allow people to use that as a quick way to get their plan of reorganization filed. So yeah, I think we've already seen an uptick. We've already seen an uptick here really in the last month in terms of cases that have been filed, and I would expect more, and hopefully we can get some of them through the process fairly quickly.
So, Bill, can I throw a question back at you, even though you're
Sure.
the moderator?
Sure, absolutely.
What are you seeing by way of how involved are the trustees here in the Western District? And just, for example, in the case that I'm involved in Ohio, the trustees pretty involved and had a couple meetings with the debtor and the bank without counsel. And I thought it actually was very productive. I think we had a more sound position, and the trustee was able to help the debtor understand that.
Yeah.
But, I saw the trustee be pretty engaged in a very helpful way. And I'm just curious if that's going on here.
Well, since you're putting the question to me, I'm going to give the answer back to you. Is it really depends. So, and I think it depends on whether they were already on a path. So if we've got a business owner and a debtor's attorney who already are in the process of identifying some potential financing sources or a potential buyer opportunity to be able to liquidate and monetize some assets that are there, I think the trustee will tend to step back. The more recent case that I have, I see a more active role in that because it's really the secured lender is not going to be an issue, but this is a situation that involves some commercial real estate and some lease issues, and I think it would be a more active role. And then in terms of the U.S. trustee, I see their activity as it should be, as it was designed upfront in terms of getting the bankruptcy process started and advising the debtor as to what their responsibility, and really they step aside after that and let the sub 5 trustees help to navigate the case through the system and get a plan, work together with debtors and creditors to get a consensual plan. So I think we'll see. The more cases that we have in, the more different types of cases that we get into the process, I think the judges certainly are interested and excited about, is this something that can actually work? And so I think their commitment there will help in the process as well. So I have 327 at this point. I have one question from the audience, and I'll leave it to whoever wants to take this one. The comment was, great content, guys, thank you. Do you believe that the market, mainly banks, will generally permit COVID EBITDA add backs? Maybe I want to try to translate that.
I can maybe start with that one. I'd
Great.
say, look, the guidance has been changing. How we've generally looked at it is to not include the PPP income, right? Sort of extraordinary income. We're going to look at it on a real run rate basis in terms of what's the company actually tracking to. I'd say similarly, we don't want to ding you if there are any taxes associated with it. I think we're still interpreting that, but if you do have to pay tax on it, then you shouldn't be hurt from a covenant perspective. But how we've started to look at it is we are going to take the non-operating income out from an EBITDA basis and look at it on a real run rate basis.
Great, thanks. Anybody else have any other comments? I think we're getting to the end here. I have 3:29 on my clock, and I think we're done at 3:30. Are there any other questions from the audience or any other closing comments that the group has on the subjects that we've been talking about? I have no questions currently. Well, I'll wait till the clock turns 3:30. No. Thanks. Thank you to the TMA for the opportunity to be able to participate in this panel discussion. And I want to extend my thanks to all the panelists who have really been thoughtful in putting this presentation together and considering what is of interest to our fellow TMA members and really focusing on their particular experience and perspectives and bringing it to the group as a whole. And so that, for that, gentlemen, I thank you for your efforts.
Well,
Thank you, everyone.
I think that wraps it up. I want to say thank you to our panel. I think as a group at the TMA, we were a little apprehensive about how this would go without the networking happy hour beforehand to keep people's attention, but I think you guys did a great job. So thank you very much. Thanks again to our attendees. We will be sending a survey link shortly following this call. Your feedback is very much appreciated in terms of the format, in terms of what you might like to see in future presentations. And please mark your calendar. November 5th will be the annual judges panel presentation. A little bit different this year, we anticipate, than previous years, obviously, but we'll be. Thanks everyone for attending. Have a great day. Thanks.
Hey, Jeb, real quick.
Yes.
I do have one comment from the audience. They're interested in getting an attendee list. I don't know if you generally provide those, but that's one of the last questions that I have from the group.
Bill, this is Ian. We'll take care of that.
Great, thanks. Thanks again, guys. Have a great afternoon.
Thanks, Bill.
Take care.